Welcome to Money Discourse. Oh man, it's been a crazy few weeks. Rajan, why don't you take it away?
Yeah, I mean, it's been a bit of a while since we've done our last pod, and look what's happened since then. I felt like the whole world has changed in those 2-3 weeks, and it's been a bit wild. Maybe we should take a few more breaks during our pod in terms of material to talk about. And I mean, where do we start? There's been so much things that have been going on with banks going under to like now people are second guessing what the Fed is going to do. I mean, we've got the interest rate decision tomorrow, and I mean, it was a nailed on, like probably 50 basis points, but now it's anyone's guess what they're going to do. But let's first start off with Credit Suisse. So we did speak about this, I think, some point at the end of last year, where we were talking about how they may be in trouble, and Credit Suisse basically took a dive, and then since then, stupidly myself, I've always tried to like think, you know what's $3, $4, this has got to be the low. Well, UBS comes in. And initially, we're trying to buy their equity out for about $1 billion, which sort of worked out to be about 25-30 cents. And then they didn't take it. And then I think they agreed to a deal, which I don't know the exact number, but it sort of implies a valuation of around $2 billion, which worked out as around 55-60 cents. And then some are saying it's around 76 cents. But what happens with that is, first of all, that was about 70% lower than the closing price on Friday. Number one. Then they've got a whole bunch of guarantees by the Swiss National Bank, who's going to cover around $9 billion worth of losses, provide $100 billion in liquidity. There's a whole bunch that the Swiss National Bank did to reassure UBS that it wouldn't be saddled with all of the garbage that's probably on Credit Suisse's books. And the thing is that Credit Suisse, probably like a lot of these other banks, were just teetering on water. And then what happened is that as soon as the bank run happened on SVB, then that got everyone panicked and everyone started to withdraw money from all these other banks, and especially banks that seem to be on the brink. And Credit Suisse was one of them. And they blamed the banking crisis in the US for their own turmoil and eventual demise, as they were on the edge. And then basically the bank issues in the US put it over the edge, and the Swiss National Bank had to come in and form a rescue for Credit Suisse. But what happened with that? $16 billion worth of bondholders got wiped out, equity holders got wiped out. And it does look like if you're going to be bailed out in this current version of a banking crisis, the equity and the bondholders are not going to get saved. It's just the depositors. And that was the case with SVB and Signature. And so it's the same thing with Credit Suisse. So the real question is now, what does this mean for bank rescues going forward? Like, how many of these banks actually want to be rescued, knowing that it will absolutely diminish their stock and the bondholders? What is the incentive for them to like try to figure something out with another bank before it gets to that point?
Yeah, so I just found a few things quite interesting. The Credit Suisse chair, he's blaming this disaster on Twitter. He's saying hindsight's wonderful, and he responded, "We had a social media storm last autumn, and this had huge repercussion." And it's actually crazy. Like, you should see what people are tweeting right now. Look, Credit Suisse the last few years lost 5.5 billion on the Archegos blow up, 1.7 billion on Greensill Capital, 100 mil on the Citrix deal. There's other people talking about how many fines they had by year.
I mean, yeah, exactly. If there was ever a scandal, Credit Suisse was number one in there. Yeah. Like any scandal that happened, Credit Suisse were like, don't leave me out, and they were in there straight away. So I mean, that bank,
yeah, it wasn't well run at all. But now, just looking at it, do you actually think that the contagion is going to continue? Knowing
what's so different now is the way banking is. Yeah. You don't get those queues in front of the banks like you did back in the day. Literally, you get your phone in an app and you can instantly transfer money. I was reading that with SVB, $4 billion an hour was getting flowed out. It was incredible. The speed at which something just unravels is insane. And the problem is, it's not whether the Fed actually is backstopping these guarantees, deposits, and that. Is whether people in general want to have their money in these regional banks, these smaller banks, rather than a big bear moth. But the thing is that, remember, all of these banks all have garbage on their balance sheet, i.e. low interest debt. We've had 7-8 years worth of ZERP, right? Yeah. So that these guys have been buying these bonds. Now the question is that how many of these hold to maturity portfolios can these banks afford to hold on to and not have to sell it, like was the case that was in SIVB? And so the thing is, if you can hold it, then you'll be fine, because you're still getting 1.5% interest or whatever it is, and hold it out to maturity and you're good to go. But which of these banks will be forced to do it? How much of their loans and their balance sheet are in these type of securities? So that's the real question, and that's what people are going to be looking more closely at.
Yeah.
And I think especially with the next earnings coming forward, I guess people are looking much more into what percentage of the balance sheet, which percentage of this is liquid for these type of bank runs and stuff like that. So I mean, I think regardless of what the Fed does, I think a lot of these people, safety is the number one thing. And this all happened just as I took out my money from JP Morgan and put it in SoFi, and then this happened. But the thing is that I don't think SoFi has been around as a bank long enough to have too much of their assets in these short-term securities. I mean, these 1%, 2% securities that a lot of these other big banks that have been around for ages for. So I think I've got a bit more confidence in that they don't have as much as these other banks, but I guess we'll find out in the coming days. But yeah, I don't know. It's a tough one. I mean, the Fed, they were going to do it. They're not going to let the banking sector, especially the regional banks, go under like some were saying. But the thing is just whether people's confidence is enough to say, you know what, I'll keep my money in the bank.
But I mean, there's huge incentive for these banks, like Chamath was saying in the All In podcast, to hand the Fed these low rate securities, which they've all acquired, and basically get a massive loan from the Fed and then use that to buy high yielding bonds. JP Morgan was saying that Fed are going to basically leverage up to 2 trillion. I don't know. It's very concerning to see how fragile the banking system is. And when you look at it, it actually came down to a bank run, right? Like, this whole situation would have been okay if it wasn't for that bank run.
This is the thing, right? You can do all how many stress tests did the Fed do? You did stress tests left, right, and center, but nothing. With the velocity of money now and how quickly things can be moved, like we just said, there is nothing that can withstand it. Because the thing is, the general model of a bank is you take in deposits, and then the multiplier effect, you keep 10% for withdrawals, and 80-90% go out and is lent out as loans or this and that. And then this is just a general bank model. And the thing is that when 20, 30, 40% want to withdraw their money in such a short amount of time, there is no stress test that could survive that. So the banking system in that particular way is flawed. Now, the real way to solve this is to try to get people to chill and realize that they don't need to take out their money and everything is safe. And then that's what the Fed, and that's what the banks, and that's what their job is. Now they have to make people realize that you can't do that. And the thing is that we know that FDIC in the US, the FDIC insurance covers up to $250,000 worth of money. And I was seeing a stat where over 85% of the deposits held at SVB was above 250,000. So it was huge amounts of money. So the thing is that, what do? You split up between all the banks? If you're a big deposit holder, you just put it in JP Morgan, Bank of America? Like, what do you do?
It's crazy. I mean, if you have to abide by those, in the UK, it's actually even less. It's only £85,000. Say if you're a much larger entity and you've got, say, 500 employees or something like that, and you're doing payroll, and how many bank accounts would you have to spread that over for 85,000? I mean, like, it's unfeasible to be able to protect. But like, say HSBC, if there was a bank run on by HSBC for some scandal or something like that, how could that bank be protected? It's all a confidence issue.
This is the worst. No, but this is the worst scenario. You've got inflation and you've got this. Now, and the question is that the markets are pricing a significant cut in rates. I mean, in terms of the movement in the bond market has been something short of phenomenal, and longer term rate funds are pricing in right now, but they're looking at 1%, 1.5% cuts. And so we just saw such a huge move in the bond market. And the thing is that, is the Fed going to follow what many people think they are going to do? Because the thing is that their whole mandate has always been inflation. And the thing is, they could look at their own balance sheet and go, how many bonds were they buying? 60 to 80 billion a month. So they could look at their own balance sheet and go, gosh, look at the mark to market on this, right? But and I'm pretty sure that they obviously must know that a lot of these banks have the similar type of balance sheet. But obviously, you ain't going to get a run on the Fed. But these banks, this is apparently, there was the Fed actually highlighted SVB a few months back as being a bank that could be in potential danger. But nothing was done, and here we go. And again, but the thing is that you never know. If we come back to Luna, remember Luna? Luna, all of a sudden, 50 billion market cap cryptocurrency, and to zero within a day. To do that, these things unravel so fast. Something that just might seem fine today, tomorrow it's done. That's the speed of it, and it's just hard to slow.
And it's only going to get worse because, you know, with AI controlling, you know, these big portfolios probably in the next 1 or 2 years, everything's going to get liquidated like that. Not even like 4 billion an hour will come out, as everyone realizes. It will all be happening in an instant. All the algos will just be dumping. The future is a bit scary like that. You know, when you think all these institutions, they're never going to fail, but some of these big ones might just end up going under. I mean, you know, just look at.
I mean, like, this is what I was talking about. So in the last 25 years, prior to the last 2 weeks, so that's about 6,500 trading days. This is a tweet from cousin Greg. He was saying the 2-year US Treasury has experienced an absolute one-day move up or down of 25 basis points 17 times. So that's about 0.3% of the trading days. And in the past 6 days, it's done that, had 25 basis point moves. That's how big, you know, like the moves have been. It's just been absolutely bananas. That was as of March the 17th. So obviously sort of settled down now since we're on March 21st. But it's absolutely crazy. And the thing is that type of volatility, how do you hedge? How do you even control your risk? It's absolutely crazy. But now, looking ahead, so we've talked about Credit Suisse, we've talked about SVB. Now the thing is that now let's talk about FRC, which is one of the other banks that are. So we were talking about this earlier. So the thing is that Signature Bank and SVB were allowed to fail, but yet there was a $30 billion injection into FRC, which is First Republic. So why did they get the injection? Now the thing is, maybe it was like, you know, in my opinion, it was like, all right, SVB failed. Signature Bank failed. Now, where do we draw the line? And I think they're drawing the line at FRC going, right, we can't allow this one to fail too, because then who's next? Because the market keeps on weeding out. Once FRC is done, they'll weed out the next one, and then the next one, and then the next one. And, you know, there's so many of these banks that have been absolutely drilled, like PacWest and WAL. I don't even know which bank WAL is. I know the ticker is WAL. And the thing is that you look at all of these banks in the KRE index, ETF, and so many of them are getting done. So the thing is that, but meanwhile, you think something more sinister is at hand with FRC. What was your thesis?
No, it's just really, it's just a thought on your point that these 3 crypto banks, Silvergate, Silicon Valley, and Signature, they were allowed to fail. And if you think about this, look at Europe, right? What banks were allowed to fail? The private market was able to do its thing and acquire it, even if it was pennies on the dollar. At least the private market was able to work as intended. And if the Fed really didn't want contagion to occur, they should have backstopped everything. But with this, who caused this whole bank run? And just do a couple of searches, and it all kind of stems from Peter Thiel, basically informing all of his companies and startups that he's affiliated with and his network that, you know, let's just get out. And then that obviously caused the bank run. And you think about it, like, he must have known what he was doing. He's a super intelligent guy. And if you now look at his history, I'm not saying there's anything sinister here, but companies that have screwed him and individuals, he's really gone after them hard, like Orca Media. You know, he literally just wiped them off the face of the earth, you know. Mm-hmm. So, I mean, did Silicon Valley, did some of these banks do something to him? Or, you know, was there some exposure to crypto that he didn't like or he had, or some reason to literally wipe these guys off the face of the planet? And literally, okay, depositors were saved, great, but why weren't investors even able to get, you know, 5 cents on the dollar if someone wanted to acquire them? Why wasn't there a Credit Suisse style deal or even a SVB UK deal done with those banks as well? What's your thoughts on that?
I mean, no, it's interesting. I think in Europe, firstly, right, there ain't as many regional banks like there are in the US. So what it is that generally, if a bank in Europe is going under, it's a major bank. Like if you look in the UK, it's basically the big 4, big 5, in Europe as well. And so a lot of these banks are too big to fail. And I think so. But you're right in SVB, the UK arm, like that didn't need to be taken over. But I guess in general, I think they're trying to draw a line in the sand here and try to let the free markets work a little bit. But I don't know, it's a tough one. There's no right answer on what to do, because you look at the general consensus among the board, and then you see that a lot of people say you should have let them fail, weed out all the best banks. The same like what's been happening in crypto, because in crypto, obviously, you've had no rescues. It just literally one after another, we've just seen the dominoes fall. But with the banking system and fiat related banks, obviously it's a different story. And I think what it was is that with SVB, I guess the clientele, it wasn't as heavily retail, but again, they saved all the depositors. But I feel like, yeah, I don't know, to be honest, I don't actually, it's a tough one. I think what it was is because it would set precedent that if they were going to get bailed out, then the next one would get bailed out. And I think the Fed and the regulators, Janet Yellen, they all saw that this is not just a one bank issue. This is multiple banks. So they had to search for some type of solution that will protect the whole industry rather than saving one bank at a time. And then if a couple were casualties, and so be it. But the overall goal, as we saw when the Fed announced this daily dollar liquidity ups with the global central bank coordination. So from going from weekly dollar operations to daily, all to provide that liquidity, that they had to do something, because obviously behind the scenes, it was a much, much wider problem. So I think what's more remarkable is that despite all of this, you see the resilience in the stock market. I mean, we went up yesterday, we were up today, and there was a big gain.
Like there's just so much more liquidity in the market now, right?
Yeah, no. Obviously, liquidity has driven a lot of this move higher in the market. But again, this market has been incredibly resilient. We've had the sharpest rate rise in history, from zero to across the board. We now have this banking issue. We've had crypto failures, but yet the market just hung in there, and it's pretty incredible. We did get a sell-off at the end of last year, but at the beginning of this year, the things that I feel like this banking crisis and this deposit issue, any other time would have tanked this market another 10%. But
yeah, so if you just look at this chart, QT with the balance sheet going down up until now, and it's kind of spiked back up. So the whole of it looks like half of the QT that they did over the last year or so has literally been negated, but that could just be a temporary blip. But what's really interesting to look at is look at when they did it in 2019, and it's literally the same type of thing. They're doing QT, it's going down, and literally boom, back up again. Like our system, the way everything is set up is just so reliant on liquidity and money just being printed. Like without that happening, it just seems like everything.
The system. I mean, the system is on tender hooks. Let's put it that way. It's just one wrong move by the banks or something, you could just see just Armageddon. And I guess this is why you saw the rise in gold, silver, especially Bitcoin, which has rallied strongly and now is trading over 28,000. But before we talk about the cryptos, I just want to bring up the chart of the S&P, and if we look at it again, we started to go off as all these banking issues start to arise. But again, we've just pretty much rallied almost all of it. And one thing that I'm seeing is, despite all of these negative headwinds, we continue to see higher lows. So we didn't take out on March the 13th, we didn't take out the December lows. And in December, we didn't take out the November lows. And in November, we didn't take out the October lows. So just getting higher lows. So the market seems to definitely have a lot of support behind it, obviously driven by this extra liquidity. And I think the market is also now getting second tailwind from the fact that now they're pricing in that we're going to get much more stronger rate cuts in the future to sort of stem some of this banking issues. So, to help with some of these mark-to-market losses. So, I mean, which already must have improved quite a bit considering how much we've rallied in the long end.
What's your kind of predictions on tomorrow's rate decision? If you look at Bill Ackman, he's literally leading them to. He's written this long tweet saying the best course of action is a temporary deposit guarantee until updated insurance regime is introduced. But the thing is, okay, say if they say, okay, now 500,000 or 750,000, whatever they say, like
they're not going to cover a 50 million. Bank, I think whether it goes into up in 100,000s is irrelevant. These are big deposit holders, which are the ones that, which is the issue, right?
Yeah, and so Elon is talking about 50 basis point drop. If that happened, oh my God, like the market would just literally be on fire.
I think they will do 25, maybe like we saw the Bank of Canada before this whole stuff happened, they held their rates. The Fed have got it to such a point where we saw the inflation print last week, which came in pretty much in line with expectations. And we got that drop to 6%. So inflation is falling according to the CPI measure, but we are seeing a lot of these PPI numbers start to go higher again. But then you just look at the numbers, like you look at oil, man, it's getting destroyed. Nat gas, virtually free. We went to a low of $2.13 today. I mean, I still don't know how our gas bills are higher than last year. It just still blows my mind. But again, nat gas is just getting absolutely creamed. There's so much oversupply. And a lot of these commodities, just in general, again, with recession fears, if this is what happens, it's going to keep on going down. So the Fed has wiggle room, but they have to. I reckon they're going to do, like they call it, a dovish raise. So they're saying that they're going to raise it, but also be mindful of the risks and signal that there's pretty much no more to come, or very little to come, which was much less than previously anticipated. Prior to all of this going on. So that is probably the overall consensus of this market, that it's going to be a dovish raise. But, I could see them holding it. It depends. I think the Fed has now took their shot. They provided unlimited, daily dollar liquidity, central bank coordination. They backstopped these deposits. The FDIC backstopped these deposits. So they've done what they're doing. The market seems pretty stable, and also the market's also pricing in 25 basis points. So I think there's no need for them to go against that, but I guess that we'll see what they do. It's a tough one, and again, they are seeing much more information than we know. They know the real position of a lot of these banks behind the scenes, and while we don't. And so if they do hold, then you sort of got the impression that it's much worse behind the scenes than we think, and a lot of these banks are in a precarious position for them to have to take that route. But if they do the 25 basis points, then I think that the Fed probably think that things are sort of under control a little bit. But so now the next topic I'd like to discuss is now, what implication do you think this has on crypto? Now, we've seen the big rise in crypto, like I just mentioned, Bitcoin above 28,000, we've seen Ethereum above 1,800. And it's funny because I was saying this to you earlier, that in fact, USD coin had $300 million deposited at SVB. So prior to the rescue of SVB, USD coin was decoupling from the dollar, and was trading at about 95 cents to the dollar on fears that they had a huge deposit at the bank. And now that the government came in and saved it, instantly went back up to $1. And now everybody's like, well, who needs the government? Get into crypto, because if you get into crypto, your money is safe there. And it's just like, it's funny how the whole narrative, like you mentioned before, has just shifted to now crypto is a safe place to be, as opposed to the government. And then the way I see this is that obviously it's provided this catalyst to crypto, but we just got to look at the amount of crypto failures in terms of the organizations that, in terms of Voyager, BlockFi, obviously FTX, how the list goes on, Luna, Terra, it's insane. But it's funny how the narrative just changes.
Yeah, and to be honest, if Binance or Coinbase or I guess crypto.com, if any of those guys fell as well, there would be no crypto on-ramp really to these crypto coins. So just like you say, Rajan, everything is all coupled together. It's just where the narrative is going. The good thing is that Bitcoin didn't pass the 15.5 kind of lows, and that shows that it does have resilience. But again, there's just a few major holders of Bitcoin that kind of dictate that price.
It's one whale away, whale dumping away from being absolutely slaughtered. I forgot the exact number, but it's something like 80% of Bitcoin is held by 2% of the people, and all it requires. And the thing is, it's like these banks, like one of them just, one of these big whales decide to dump their Bitcoin, and then that's it. You just get a massive. And I think Bitcoin held pretty well because there's a very small float that was actually pushing it down, and the majority of the people were holders, and so you didn't have that huge exit, but yet we still saw it go down to 15,500. So at this point, Bitcoin does look good. It's had a great run at 28,000. It probably can go further, but again, all it needs for one reason or another, just a big whale to exit, and you'll see a lot of pressure on the price again.
Yeah.
And
so it doesn't seem to be able to break the 28.5 at the moment. So it really depends. Is it going to retrace, or is that narrative going to kind of push? You see Balaji's and a few of these other guys talking about BTC to 1 million, and he's betting, I think, $2 million that this is going to happen, and we're going to, because of the fact that we're going to have a hyperinflation contagion within 90 days. What's your thoughts on that? Was he just pumping?
Yeah, I mean, he's always been a bit extravagant in his idea. Cathie Wood 2.0, probably the souped up Cathie Wood. But I mean, look, you can never say never. But again, I think as of now, things seem to have stabilized. You could see that, we're seeing quite heavy action on just the odd few names, but in general, we've seen a bit of restorative, in the markets in general. Like, it seems like we've stabilized all over. The real thing is that now we're seeing a bit more emphasis towards the growth stocks. We see a lot of growth stocks rally today, just purely because of the whole thought about interest rates coming down, and that's going to be pro growth stocks. So I saw a lot of the shit that I held, rally a little bit. Like today was quite an amazing, just general day. Like, you obviously had Tesla up about 7-8%, but pretty much everything like 10%. Ginkgo Bioworks, that was a dog of the century, that was up 11%. Just a load of these names. SoFi, that's been dog as well, but that was up 6%. So we've just seen a lot of these names come. But is there any sustainability? I guess now the Fed is the big elephant in the room. Let's just see what their stance is. Because if they come out really hawkish tomorrow and pretty much just say, nope, inflation is our number one goal, and we are going to do everything we can to stop inflation, then I don't think we're going to see these stocks up here for that much longer. Let's put it that way. So it's going to be very interesting to see what happens tomorrow.
Yeah, things can change just on a dime, and just be careful with the short-term trades at the moment. But at the moment, it looks very bullish for stocks, and because I don't think that everyone believes that the Fed can't really get out of this without really messing things up, right?
There's a lot of optimism just in general. In I think people are just like, it'll be sorted, it'll be fine. And then you've obviously got these birds that are saying that this is the end, this is going to be this is going to be that. But it's fine. But I mean, just in general, if we're talking about trading positions, I think I've been the lightest. Apart from just the overall long stocks that I hold, a lot of them are bag holders and that. But in terms of just general trading, I've got the lowest amount of positions I've had in a very long time, because again, you just got to be really, really selective, I believe, and some of these stocks have run up so much that it's a bit difficult to play them, and you've seen this volatility crush. But I did play a few of them. I had a good fun playing FRC on the day where we had that. I got a nice 50% quickly on the bus coming back from New York. That was a good one. And in general, like, I sold some premium in KRE and in Charles Schwab as well, because we had some incredible heightened volatility on all of these regional bank names. Like the IV was over 500, 600 for some of these things. So the volatility was so high that you just short some of it. Sold some of this premium, and then within a day, basically made 50%. So it was quite a few decent opportunities like that were like day trades. But in general, just keeping it light. I think right now I closed out today a KRE one and a Tesla one as well. So I've only got like 3 positions on at the moment. So it's very light, very light.
What do you think about this? Underwriting ops issues restrictions for Citadel Finance LLC 2026 senior notes underwriter UBS securities. Yeah, it looks like UBS is preparing or could be in the process of covering short positions held by Credit Suisse.
So this is it. So today we had the GameStop earnings, and GameStop went bananas. It was up 30-odd%, 35% after hours. They did report a profit, an unexpected profit for the quarter, and their revenue also came in ahead of consensus. And the shares were around $17, and now it's at 23. So there's obviously a lot of shorts that covered on this to have this gigantic move up. And let me just see where it's trading right now. So It's up 52% now. GameStop after hours on those earnings, trading at $27, having closed at 17.64. So we're trading at $52. And now you see there's liquidity is low after hours. We're seeing people scrambling, 52% up. That earnings doesn't warrant a 52% move. That
if you couple it with this news of, you know, in the process of covering short positions potentially, I don't know, you know, all these things, or maybe it's just even a rumor. Who knows?
No, this is it. This is where Hello Kitty, all of these guys are all coming out. The Reddit forums are going light right now. They're smelling the blood, and then that's it. They're going to go hard on them, and this could just.
It's like 2021 again, where you know,
50% on GameStop. That is incredible. I wish I could trade it right now on the option front. Tomorrow morning, I'm going to be all over that. Like, this is what you want. You want some move like this, but, you know, play it in a good way, and let's just see what happens. But let's hold my beer. Let's just see what happens with this one, because I mean, how many other people are caught short GameStop? Now you got this 52% move. It's going to be interesting.
Okay, so let's just do our last predictions for the Fed tomorrow. What do you think?
Right, that's it. It's either two things. I think it's not about predicting what they do. It's about letting what they do dictate what is actually happening. So I think, you know, the market says quarter of a basis points, and if they do quarter of a 25 basis point, and it's likely to be a hawkish, a dovish raise, it sort of implies that things are a bit under control now, things have settled down, and we're good to go. But if they cut, or, you know, not as much if they hold, but even if they hold, then it sort of implies that things are not so good behind the scenes, and there's cause for worry. And in that aspect, then I could actually see the market initially popping, but then reversing, because they're asking what else is wrong and why have you taken that action. So regardless of what they do tomorrow, the long end is still going to keep on getting bought up, because the market ain't going to be buying it. So we're going to have short-term rates higher, long-term rates lower, and that's basically what it is, you know. And that's my take. But yeah, I mean, it will be widely watched. I'll be intrigued. Definitely, obviously, like all of us, we'll be keeping an eye on it. So let's just see how it works out.
Yeah, that's been it for us today. Thanks for watching. Please like and subscribe, and we'll see you guys in the next one.